Arquitos Capital manages an unusual portfolio, investing in special companies going through unique circumstances. We focus on areas where mispricings provide outsized opportunities, and the fund has demonstrated success over its 9-year history by making large allocations in companies where there's a high level of alignment, where the company was led by an effective capital allocator, and where the risk of permanent capital loss was low due to the strength of the company's balance sheet. Arquitos takes concentrated positions in significantly mispriced companies. We have the willingness and conviction to hold positions over the long term, and the discipline to withstand volatility. Over our 9-year history, Arquitos' strategy of taking concentrated positions in unique companies going through unique situations has resulted in outsized returns. In baseball parlance, Arquitos has a high slugging percentage. We understand and appreciate that extreme opportunities are rare. We work hard looking for those opportunities and are comfortable waiting until we find them. Our edge is balancing that patience with aggressiveness when it is warranted. After graduating from law school, I worked in public policy in Washington, D.C., which provided an interesting perspective on the regulatory environment at the time. I also have had a 20-year career in the Army Reserves that included service as a judge advocate, as well as a deployment to Iraq in 2005. These experiences provide great perspective on risk management. Understanding that things typically don't go as planned, the question becomes how you protect yourself, knowing that that's the case. I launched Arquitos in 2012. We later took over a small public company and transformed it into a growing niche asset manager. Being the executive chairman of Enterprise Diversified over the past 6 years has given me unique insight into the behind-the-scenes decision-making that occurs at public companies. This perspective makes you humble when you are doing analysis of other companies. You appreciate just how much you will never know about what's happening behind the scenes, and it makes you appreciate the qualitative aspects of what makes a company: the management, the incentives, the motivations, and alignment. There are numbers out there, but you realize that numbers don't tell a full story. You have to understand them, of course, and know that the direction they are going in, but there's so much more to that. I would not make an investment decision without the ability to make a commitment and have the proper discipline to own the company long term. Ultimately, it's that qualitative analysis that informs the conviction. I like to go to primary sources: SEC filings, proxy statements, employment agreements, S-1 filings, just as a few examples. I have different alerts set up, not just for specific companies, but for types of filings and keywords that could lead to situations that can be misunderstood or not fully appreciated by the market. For example, employment agreements that have language that might change year over year, where different metrics or changes in metrics are noted. You can glean the conversations that are happening at the board level that reflect the internal goals for the company that have not yet been provided externally. Additionally, I have an incredible network of colleagues, both within Willow Oak and beyond. Those relationships provide tremendous value for idea sourcing, perspective, and research. I tend to screen more on a qualitative basis. I'm looking for key pieces of information that speak to a value that is yet to be unlocked. It's about finding the edge there and deciphering the incentives. To borrow a common phrase, I approach research bottom up and risk management top down. I'm looking at specific companies through the lens of primary resources. There are marketing pieces that companies put out, investor presentations and things like that I tend to be a little bit skeptical of. But it's interesting to consider and understand what management values. Talking to management on occasion, talking to competitors, and talking to other investors in my network. There are a whole host of things that I generally tap into when looking at companies to invest in. Ultimately, I'm looking for situations that there is so much value, the mispricing is so great, that you don't need to be as precise as a sell-side analyst might be in terms of predictions. I want to be directionally right. This is done by getting a comfort level with the financials of the company and the people involved. Sometimes the time is spent getting an understanding, and other times it's spent determining if I can create a commitment level to the company. Coming into it, I can appreciate that there is a value gap for that company, and at times the gap might widen, and I have to have the conviction and commitment level to both withstand the drop and increase the allocation size. We typically own about 12 companies, with the top 5 positions making up roughly 75% of the portfolio. I'm industry agnostic, generally in order to remain nimble and invest in the best opportunities. Beyond being the mechanism to achieve higher returns over time, the concentration of the portfolio matches the personality of the investment manager. I would much rather have a small number of companies that I know very well, that I follow very closely, and that I've participated in over time. The sizing of positions is determined by my commitment level and the valuation gap between my interpretation of the long-term value of a company and where the stock market currently prices it. The companies in our portfolio provide safety because of their balance sheet strength, but also they must have long-term reinvestment opportunities over time. We look for companies where there is high insider ownership, share buybacks, investor-friendly policies, and other similar indicators. We'll make large allocations when I identify heads I win, tails I don't lose situations. This alignment carries through to our investors. We have, and are looking for, patient, disciplined, long-term oriented investors who understand and embrace our investment philosophy and understand that volatility is an opportunity, not a risk.